Hey everyone, and welcome back to The Explainer. Today we're tearing down a really fascinating financial mystery. We're looking at a company that honestly on paper looks like an absolute income dream. But if you scratch just beneath the surface, it might actually be a classic value trap. We're talking about Bain Capital Specialty Finance, ticker symbol BCSF. Our goal today is to give you a super clear, structured look at the raw data so you can decide for yourself what's really going on here.
Right off the bat, just consider that number. A 13.5% dividend yield. I mean, in a world where standard safe bonds are paying, around 4%, this stock is offering you nearly 14 cents on every single dollar you invest every single year. And to top the whole thing off, you can buy it right now for just 74 cents on the dollar compared to its net asset value. It sounds absolutely incredible, right? Like literally the ultimate income dream. But as we always do here, we've got to look a little closer.
Okay, let's dive into this, because this is exactly where the nightmare scenario begins. While that 13.5% dividend yield is flashing bright green, the underlying earnings of the company are flashing a massive, glaring red warning sign. In their last quarter, their GAAP profits collapsed by nearly 88%. Yeah, 88%. This incredibly jarring contrast between a sky-high payout on one hand and completely collapsing paper profits on the other is exactly why we need to put this company's financials on trial today. All right, moving on to Section 2, exploring the business model. So before we can truly judge the numbers, we really need to understand what it is we're actually looking at. Bain Capital Specialty Finance operates as a BDC, which just stands for Business Development Company. If you're new to that term, just think of them as an alternative bank. They lend money to middle market companies. So we're talking about, factories, mid-sized healthcare providers, growing tech firms. These are businesses that desperately need capital to grow, but for whatever reason, they just can't easily secure a traditional bank loan. So BDCs step in to fill that gap, and they charge a hefty premium for it. Now, understanding this really brilliantly illustrates how they manage their risk. If you look at their portfolio of over 212 companies, 66%, so about 2/3 of their investments, are in first lien senior secured loans. And that is a crucial detail for us. First lien basically means they are standing at the very front of the line to get paid back if that borrowing company happens to go bankrupt. It's literally the safest tier of corporate debt. So on the surface, this looks like a well-managed, highly secure portfolio that's just generating a massive yield.
But let's turn to Section 3, the hidden red flags.
Oof, okay, this is a disastrous number. There's this famous financial health metric out there called the Piotrowski F-score. It basically grades a company from 0 to 9 based on things like profitability, leverage, and liquidity. Well, Bain Capital Specialty Finance scores a miserable 2 out of 9. That means across almost every single major category of operational efficiency and financial health, this company is actively failing. So this isn't just a minor hiccup, right? This indicates some really serious financial pressure under the hood. Let's move to what I'd call the absolute ultimate Warren Buffett deal breaker. Look at this. Their return on invested capital is just 4.5%. But the cost of that capital, like the money they actually have to borrow to make those loans, is over 5.3%. Think about that for a second. When you're borrowing money at a higher rate than the return you're actually generating, you are literally destroying value with every single dollar you reinvest. If Warren Buffett looked at this one single metric, he would run away screaming, for sure. And honestly, the prosecution's case just keeps piling up here. We already mentioned that GAAP net income is down almost 88%, right? Well, that was driven by a $25 million paper loss on their portfolio. Next up, their net asset value, or NAV, dropped 2.1% in a single quarter, falling from $17.23 down to $16.86 per share. Now, if you're buying a stock at a discount, but the asset itself is constantly shrinking, that discount might totally be an illusion. Then we look at insider ownership. It's just 0.70%. The people running this company have virtually zero skin in the game. And finally, the massive conflict of interest. BCSF is externally managed by Bain Capital, and they charge fees based on total assets under management, not on actual performance. Basically, they get paid when they raise more of your money, not necessarily when they make you money. Let's flip the script, though. Section 4, the compelling green flags. Because let's be real, in the world of finance, nothing is ever just black and white. It's time to hear the defense's argument, because we absolutely have to talk about the valuation. Right now, this stock is trading at a staggering 26% discount to its net asset value. This means that for every 74 cents you spend on this stock today, you're essentially buying a full dollar's worth of underlying assets on paper. Historically, BCSF trades at about a 13.6% discount. So right now, it is nearly twice as cheap as its own historical average. Legendary value investor Benjamin Graham would look at this and call it a massive margin of safety. So the really crucial point here is that giant 13.5% dividend actually safe? Well, surprisingly, the data says yes. In their most recent quarter, net investment income, which is the actual hard cash generated from their loans, was 42 cents per share, and that perfectly matched their 42-cent dividend. In Q4, the coverage was actually even higher at 110%. So the dividend isn't being paid out of the principal or anything shady, it's being fully and comfortably covered by the actual cash flow of the business. And when we zoom out to look at the broader health of the portfolio, those green flags just keep waving. Non-accruals, which is finance speak for loans that have basically stopped paying, are sitting at just 1.4% at cost and a completely tiny 0.6% at fair value. That means less than 2% of their entire loan book is in actual trouble. Plus, they've got what we call fortress liquidity, $729 million available, which includes $660 million that's completely undrawn. Basically, they have the cold hard cash to weather a severe economic storm without being forced to fire sell assets at a loss. Add in the fact that they're highly diversified across 30 different industries, and you're looking at a surprisingly resilient portfolio. We also literally cannot ignore the elephant in the room here, the Bain Capital name itself. As Dan Jick, the CEO of BCSF Advisors, points out, the company benefits directly from Bain's unique global platform. And yeah, we talked about how that external management structure is a huge conflict of interest. But the flip side to that point is that you're getting direct access to one of the most successful private equity firms in history. They have this enormous deal sourcing engine and a world-class credit analysis team that retail investors like us could just never access on our own.
All right, let's put it all together. Section 5, the investor face-off.
I love this because this data illustrates exactly how differently you can view the exact same company. First up, we have Benjamin Graham, the absolute father of value investing. He looks at a PE under 15, a price way below the NAV, and he just screams buy. I mean, it's pure math for him. Buying a dollar for 74 cents gives him that deep margin of safety he demands. Next, we have Peter Lynch, the legendary growth at a reasonable price guy. He looks at the PEG ratio and gets totally spooked by that terrifying 88% gap earnings collapse, so his verdict is a solid wait. He really needs to see actual earnings growth before he jumps in. Finally, Warren Buffett. Buffett looks strictly for quality. He sees a return on invested capital that is lower than the cost of capital. He sees zero competitive moat, that misaligned external management, and absolutely no pricing power. His verdict, a hard, fast avoid. Which brings us to Section 6, the final verdict. Synthesizing everything we've looked at today, Bain Capital Specialty Finance is essentially the ultimate Rorschach test for investors. If you're a Graham-style income investor, the math here is incredibly attractive. You're getting a fully covered 13.5% yield at a really deep discount to its underlying assets. It is your classic income asset. But if you're a Buffett-style quality investor looking for a business that's going to compound intrinsic value over decades, you have to walk away. The value destruction metrics and that misaligned external management are just way too much to overcome. This stock belongs only in portfolios that require immediate, heavy cash flow, not portfolios chasing 15% annual compounding growth. And that brings me directly to you, the focused learner. Based on all the evidence we've structured in this explainer today, I want you to ask yourself one critical question. Are you investing for current income right now, or are you investing for long-term capital compounding? Because honestly, your answer to that specific question completely dictates whether a stock like BCSF is an absolute income dream or a dangerous value trap for your specific strategy. Now, as we wrap up this explainer, I do need to leave you with a really crucial disclaimer. None of this is financial advice. Business development companies are highly, highly sensitive to interest rates and credit cycles. While that 13.5% yield looks amazing today, in a severe recession, those yields can be slashed and that net asset value could drop significantly. So please, always do your own homework. Let me leave you with this thought. In a market where totally safe money pays 4%, is chasing a 13.5% yield a stroke of absolute genius, or are you just picking up pennies in front of a steamroller? Let me know your verdict down in the comments. Thank you so much for joining me for this explainer, and I will catch you in the next one.